Welcome to the advanced course on the Elliott wave principle. In our previous beginner's course, we covered the basics of Ralph Nelson Elliott's discovery and how he found that financial markets tend to follow predictable patterns made up of 5 waves in the direction of the larger trend and 3 waves in the opposite direction, corrections. One of the key takeaways from the beginner's course is that the Elliott wave principle is fractal in nature, meaning that it applies to all degrees of trend, regardless of the time frame. In this advanced course, we will dive deeper into the fractal nature of the Elliott wave principle, exploring how it applies to different time frames, and how to use it to make more accurate market predictions. We will examine how Elliott studied multiple time frames, ranging from yearly to half-hourly, of the Dow Jones Industrial and Dow Jones Transport Indexes, and found the same patterns, regardless of time frame. We will also explore more advanced techniques for identifying and analyzing these fractal patterns in the market, as well as strategies for incorporating them into your own trading or investing decisions. By the end of this course, you will have a thorough understanding of the fractal nature of the Elliott wave principle and how to use it to make more informed financial market predictions. So, let's begin. The Elliott wave principle states that movements in the direction of the larger trend unfold in 5 waves, referred to as motive waves. Within these motive waves, there are 2 types, impulse and diagonals. As shown on the screen, waves 1, 3, 5, A, and C each divide into 5 waves, which are in the direction of the larger trend. Conversely, waves 2, 4, and B divide into 3 waves, which are against the trend of the larger degree. It's important to note that there are 2 rules that all motive waves must obey, as we discussed in the beginner's course. First, wave 2 never retraces more than 100% of wave 1. Second, wave 3 is never the shortest wave among waves 1, 3, 5. This structure of the motive wave is crucial to understand and interpret the market trends and patterns. Impulse waves are a common type of motive wave in which wave 4 does not enter the price territory of wave 1. However, in the foreign exchange market, with its high degree of leverage, it is possible to see overlapping on intraday charts. It is important to note that this is rare. During strong trends, the price may extend and typically, wave 3 is the extended wave. However, it is also possible for waves 1 or 5 to be extended. As a general rule, only one wave will be extended or significantly longer than the other motive waves. Diagonals, also known as wedges, are a pattern that is commonly seen in the 5th wave position following an especially strong 3rd wave. When this occurs, the pattern is referred to as an ending diagonal. In an ending diagonal, each wave, 1, 2, 3, 4, 5, is made up of 3 waves zigzags and waves 2 and 4th of may overlap. It's important to note that reversals from ending diagonals tend to be sharp and the entire diagonal is usually fully retraced. To identify an ending diagonal, look for the line that connects waves 1 of the smaller degree and wave 3 of the same degree, as this can provide an estimate for the end of wave 5 of a smaller degree. Additionally, if wave 3 is shorter than wave 1 of smaller degree, which is common in a contracting diagonal, the initial stop should be placed at a distance where wave 5 equals the length of wave 3. This is because, if the wave labeling is correct, wave 3 of the smaller degree should not be the shortest of waves 1, 3, and 5. It is also important to note that diagonals can also appear in the wave 1 of the larger degree position, and similar guidelines apply. In Elliott wave theory, a triangle is a common 5-wave pattern that is characterized by overlapping and usually contracting waves labeled A, B, C, D, and E. These waves are composed of 3 subwaves, which can be either zigzags or triangles. The triangle pattern is considered a corrective pattern, meaning it moves against the trend of the larger wave. The 5 waves of a triangle are as follows. Wave A is the first leg of the triangle and is usually a sharp move in the direction of the larger trend. Wave B is the second leg of the triangle and is a correction of wave A. It typically moves in the opposite direction of wave A and can be a zigzag or a triangle. Wave C is the third leg of the triangle and is another sharp move in the direction of the larger trend. It is often equal in length to wave A. Wave D is the fourth leg of the triangle and is a correction of wave C. It typically moves in the opposite direction of wave C and can be a zigzag or a triangle. Wave E is the final leg of the triangle and is a correction of wave D. It typically moves in the same direction as wave A and is often equal in length to wave B. The triangle pattern is often seen as a fourth wave or B wave in the larger wave pattern. The fourth wave is a correction of the impulse move of the third wave and the B wave is a correction of the impulse move of the A wave. The triangle pattern can be difficult to recognize as it unfolds, but as the pattern nears completion, it becomes more clear. Traders can position for the next wave by initiating positions near the end of wave E and placing a stop below wave C. The Elliott wave theory describes also a pattern called a zigzag, which is commonly found as a second wave or B wave in a larger trend. A zigzag is a three-wave pattern composed of ABC waves. The first wave, labeled A, is a motive wave, meaning it moves in the direction of the larger trend. It is composed of 5 subwaves. The second wave, labeled B, is a correction wave, meaning it moves against the trend of the larger wave. It is composed of 3 subwaves. The third wave, labeled C, is another motive wave, also composed of 5 subwaves, and usually moves in the same direction as wave A. The Elliott wave theory also describes a pattern called a flat, which is commonly found as a fourth wave or B wave in a larger trend. A flat is a 3-wave pattern labeled ABC, similar to a zigzag pattern. However, the subwave compositions of a flat are different from those of a zigzag. In a flat pattern, wave A is composed of just 3 subwaves, wave B terminates near or beyond the origin of wave A, and wave C typically ends just beyond the end of wave A. In terms of subwave composition, the divisions of a flat are 3-3-5, while a zigzag's divisions are 5-3-5. There are 3 types of flats: regular, expanded, and running. Regular flats are the most common, expanded flats are more common than regular ones, and running flats are the rarest. In the Elliott wave theory, a prolonged period of sideways or corrective action can be the result of a combination of multiple corrective patterns, known as a complex correction. A complex correction is composed of 2 or 3, but no more than 3, corrective patterns that are connected by an X wave. These patterns are labeled W, Y and Z, with the first and third patterns being labeled W and Y, respectively. In a triple combination, there is a fifth pattern that is labeled Z. This pattern is used when there is a need to identify a specific pattern within the combination. It's important to keep in mind that these patterns are subjective, and there is no guarantee that the pattern will unfold as expected. Additionally, it's important to use other technical analysis indicators to confirm the pattern, and also to be aware of any fundamental events that could change the tide of the market. In conclusion, the Elliott wave principle is a powerful tool for understanding and predicting market behavior. This video course has provided a comprehensive introduction to the basics and some advanced aspects of wave analysis and how it can be applied. The key to success with the wave principle is practice and consistency. As you continue to study and apply the concepts, you will become more proficient in identifying and interpreting wave patterns. Remember to stay updated on current market conditions and seek out additional resources to expand your knowledge. Thank you for taking this course and I hope it helps you in your trading journey.